So hello everyone. We are recording now. So if people are not with us now, they can hear it later on. So this is the, as I told you, this is the test. This is the test for test three. Mostly, we will have more calculation this time, and all the resources already is in Moodle. I have some recording also for all tests. Now, I have a question here from one of the students. She's saying, if the old test you have, I uploaded, if there is anything about week 9, which is the deer, please ignore it. Anything about market risk, ignore it. This test will be only about week 6, 7, and 8. So the old test, there was some overlapping. Thank you for the question. And yeah, so any other questions? Yeah, there is another question maybe. Okay, thank you. Um, it's good to ask now anything top of your mind, anything before we forget. It will be useful for the people who are listening and for you guys. I think you are this time very stressed, my friends. I don't know why. Uh, this time of the semester, I know it's clear, very clear, sir. Will this session will be recorded? Yes, this session will be recorded. I'm recording it now. There is a new question, sir. For the tutorial 6, question 5, the tutorial answers are different than the textbook. I don't know which question you are talking about, but let me check it in my PC now. Question number 5. Uh, question number 5. So the question is saying, how is deposit institution distribution pattern of net deposit drain affected by the following, the holiday season, right? Is this the question?
Yes, sir.
So question number 5, A or B or C, which one?
So for C, yeah, the recession thing. So I'm just curious because the textbook answers they mentioned that the distribution shifts to the right, but in the tutorial, both of them, the inflation and the recession shifts to the left. So can you maybe clarify that?
In the text, they say shift to the right.
In the
Yeah,
textbook, yeah.
yeah. My explanation for C, you are talking about C and D, right?
Yes.
Yeah. So for C, my explanation was that for the sake of the exam, please now, before we go to any confusion, just stick with the tutorial so we don't confuse anyone. Stick with the tutorials. This is for the sake of the for the test. But for my explanation now, when you have uh, when there is a severe economic recession, there will be no opportunity in the market to put your money. And therefore, you will find that the best way to put your money, also banks are giving, less return, but either you keep it as, cash, or you put it with minimum return from the market, from the banking system. So you put it as deposits in the bank. And this is why we expect the, the distribution to shift to the left, because the deposit additions will be more.
Oh, okay. And that's the same for inflation?
Yeah, so for an inflation, the case is different, because in the inflation, the government will start with these economic policies, and the economic policies, they will try to, cool down that inflation. And one of that is the monetary policy. So the monetary policy will ask the financial institutions to increase, they will increase the overnight rate, and the interest rate will be increased. So they want to shrink and dry up the liquidity in the market. So the interest rate will be increasing, and that will be, there will be a motivation for the depositors to put their money to get benefit of that, high rate. And this is what it's an effect of monetary policy. It's different reasons. So in this case, there will be more deposits, and the shift will be to the left.
All right. And can you elaborate for the distribution? Like, how do we know it's like widened? How do we know it's narrow?
It's about the being narrow or within. It's about the tails, and it's about the standard deviation actually. So now the standard. See, when you have a very symmetrical distribution, then the two tails will be okay. But when it will be skewed to the left or to the right, which we have here, then the distribution will be narrowed in one side.
Okay, so we have to refer to the standard deviation.
Yeah, it is about the standard deviation. And as I told you, the skewness. Now there is a skewness. It's not actually, it's not really symmetrical when there is shift. Symmetrical means the mean should be 0. But as you can see, when we shift to the left or to the right, we are moving from the 0.
Okay.
Yeah.
Thank you.
Thank you very much for your, but I don't know why my explanation, for the sake of, please stick with this explanation. Okay, guys? And thank you very much for the question. This is very good question. Any other questions, guys? For the test, for the structure, for whatever? Just, okay, for your preparation, if there is no time now, just go for the workshop and the tutorials first, and then move later. I think I have here too many, especially in this workshop. You concentrate in the workshops and on the tutorials first, and then go move to the next stage and look to the all tests. If you spend 6 hours time or whatever, I think you can do it. You can 6-7 hour times, focused, you will be okay. What I will do today after we record, then I will, whatever I can solve in this settings, I will solve. Other than that, tonight I will upload the, I should upload this recording, and I should upload the answers. So if you have any questions, it will be useful so other students can hear, any of you. It will be good. Thank you for any questions if you have, because it will be useful for everyone. Okay, so if I come now to the pre-class activity. Pre-class activity, I think everybody is doing well. I think it's for motivation, but actually we are done. We already we have done 9 we have only one, and I want to keep this one for week 7, for week 12, because week 12 regulations, and I have no intention to include it in the final exam. So I want to have an excuse, not really an excuse, to say that we have already pre-class activity, and the learning objective of that part has been satisfied. This is what I'm going to do. So no pre-class activity for week 10, 11, maybe in week 12, I will give you something about the regulations, and hopefully you will do well as usual. This is a 10 marks. It should be, most of you should get it without any problem. Okay, guys, let me first show you the results, because this is what you care about most. Results are, of course, this time was good. Come on. Okay, this is the results, my friends. Can you see? Yeah. So, yeah. Okay. Thank you very much for those people who are answering, so I can be sure. So it's 8, 10. I have only 2 students who get, I think, 6, 6, and 8, 4, 4. So the problem this time, my friends, only 150 students tried. Then I think 3 students tried and sent me an emails, and I allowed them. The rest, I don't know where they are. So what I did this time, I don't want to be like this spoon feeding all the time. So I usually before the closing, I send an email, and I send also for week 9. I just send an email before for people who didn't, did it. So I send them an email, and hopefully they will do it. But this time around, 25 students miss it. Okay. Let me now go to the results. This is the best answers. And so for question number 1, digital official banking can decrease credit risk dramatically and maybe bring it to 0 levels. Of course not. What? Hello? Hello? Can you hear me?
Yes, sir.
Yeah, okay. Okay. Yeah, let me see, because I heard somebody talking. Yeah, cancer. Okay. Okay. So guys, for the first question, digital banking is about actually, this is my understanding. You can give me your, input if you like, but digital banking is only about this, what you call customer experience, and this digitalization, which means using the, non-office, using all technologies to run this banking business. And usually this is very useful for the payment system, and for the payment system, and for usually the payment system and the experience. But if I give a loan, a housing loan from this digital banking, or personal loans, or any other things, it's a different issue. The loan is still loan. The risk is still risk. Taking the customer, the right customer, all this modeling we have done is still the same. So actually no difference. Maybe this incompetence, which means the current conventional banks are stronger in this because of the experience. So the answer is false. Number two, it is most likely that virtual banks can decrease this operation cost. Yes, because of technologies, it's given. You have no, less employees, less rent, less using utilities, less everything. They may spend more in the following of these systems, which is the IT work and the IT systems and all of those technologies. But other than that, actually, the cost will be dropping very much. By the way, I think I don't know, my bank, they have around 390 branches. In Malaysia, they already closed, they say 30 banks, 30 branches or whatever. Now they are doing the digital banking by themselves, those incompetent banks. There is licensing in Malaysia, but actually not in starting. So Malaysia, Hong Kong, and Singapore already operating virtual digital banks. I understand that Hong Kong started giving the license. So Hong Kong and Singapore are working and operating. It's only Malaysia is not operating. They don't have this digital banking yet, completely 100%. And this is why this question, they are negotiating, they are working in it. So it's actually false because I include Malaysia in this statement. Okay, which of the following statement is correct? Maybe this one is a little bit challenging. Not challenging, it's just needs some thinking. Virtual banks can be very useful in helping underbanked. This is the right answer. Why B is not right? Virtual banks are very profitable. No, because of the customer base now, they are not more profitable than, actually profitability is one of the biggest problem now because of the low customers, actually in these places where they are starting to operate. Virtual banks may not be able to develop credit scoring models. They can, and they can do it better maybe because of technologies. Virtual banks can charge higher fees, and they don't even need to worry. The whole statement is not right. They tend to charge lower fees, and there is too much concern about the cybersecurity about it. And all of the listed options is correct. So we, end up choosing A. Now, for these questions, I like the answers. This is the best answers, by the way. We don't have a lot of this time, but I was actually looking for someone who will talk about this. And this is actually my feelings. Maybe your feelings is different from mine, which is virtual banks will not be able to grow. They don't have the customer, the data, and probably cannot be profitable. They will not be able to compete with incompetence, which is the current, because now as I told you, the current banks, like Maybank has done this before. They have what we call the Maybank sandbox, where they bring all those people to help them. Digital banks, when they come, the problem with them is the customers. They don't have the customers. You have to have a minimum deposits to operate as a bank. You have to have, funds to start giving loans, to operate this financial intermediation. So actually, I think those big banks, they will digitalize themselves and be in themselves as digital banks. But we will not have a bank just come and be a digital bank. They can say, for example, Public Bank or Maybank, whatever, they start to update themselves and they started to open branches for, but they still, as a bank, they have outlets where you can walk in and do all these things, and you will have outlets where you can do everything online. Like when we have here in Monash, we have that I don't know whether you remember 2 years ago, 1 year ago, when we were there in Monash. Maybank has an outlet, and in this outlet, we have only 1% there. I think one staff from Maybank, and they were doing all the stuff, and they were planning to leave, and you can go and do everything there. Then, this is one of the issues. Yeah. Um, um, I like this guy. I think one of you. So all of the answer were actually between B and D. Most of the answer between B and D. So this is the person I was looking for who agrees with me. I don't know. Maybe I'm wrong and he's wrong. I am not sure. It is because many things that we thought that was not able to be run digitally has actually been operated digitally. I think with enough resources and time given, digital banking can be, since it's more efficient and cost saving, we don't have to print out all the documents. With that development of virtual banking, we can apply for services without even stepping out of the house. It's more time savings. I think he was when he said I'm not sure. I don't know what does he mean by I'm not sure, but he or she. But I think he was referring to option C. I think there is another one here. Yeah, this one. And B and D. Choose one. Choose B or D. Okay. So as you can, this one, I think. This is the one I was looking for, not the other one. I feel the virtual banks simply do not possess the optimal resources in order to compete with the already established giants in the banking and financial industry. However, I don't agree with the statement that they are not profitable. So he agrees with Bart, or he or she agrees with Bart of the, is the person here around us? Raise your hand if we can see you.
Yes, sir. No.
Oh, this is Won. This is you, Won?
Yes, sir.
Oh, okay. Okay. Get you. Yeah. Thank you, sir. So, yeah, so it's,
Or
yeah.
also you mean this personality is not me. It's not me.
Oh, okay.
I asking something else. Sorry, sir.
Okay. That's okay. So this person is saying maybe he's around us or she's around us. However, I don't agree with they are not profitable. And the industry is everything boils down to consumer preferences, and most consumer would prefer banking their business to taking their business to leading banks as opposed to virtual banks, which is in the introductory stage. However, since the industry has incorporated features of digital banking into their culture, this is what I mean. There is a possibility for relationship between incumbents and virtual banks to blossom. So he thinks that the commercial incumbents, which is the current banks, are the ones who are going to take the business. So when you come up with 100% digital banking and you want to establish now in the start, you will have problems because those giants already in the market, they will not give you the customers. What are you going to do to provide digital banking? They will do it themselves. This is, I think, what he means. And this is what I was thinking. Maybe I and him or her are wrong, and all of you guys are right. We don't know. I just think there will be much competition. Yeah. Any comment, my friends? If there is no comments, then we go to. If there is no comment, then we go to the workshop. So what I will do now, I'll just send this because I want to write. Okay, my friends. Okay, if you have the questions now with you, the first one. Okay, so all of those around 17 questions, the first 17 questions are actually liquidity, and I want you actually to look at them. So this is the first question. So you have been provided with this table, and in this table, this is the note, and this is the liquidity source. Whether it's asset or liabilities, and this is how you address it. And this is what we expect to impact on the balance sheet or the size of the bank. Which is this column. This is column 1, this is column 2, and this is column 3. So if we have loan commitment, which means we paid, if we address it through the borrowing from the interbank, so actually the assets will increase by this, and the liability I will borrow will increase. So finally, the total assets here, the total liabilities here, and the total assets will be increased. So this will be increased by the loan, and the loan is increased by new liability, which we borrow with. So this liability increase. So actually the size of the bank will increase. And the number 1 is right. Number 2, we have unexpected deposit withdrawals. So the problem is coming from the liability sides. So the liability side is going down because there is withdrawal. If I address it by borrowing from the interbank, so the interbank is here, so it will go with the same amount. So actually the total assets are not touched. The assets here and liabilities here, the assets are not touched. So actually the amount still the same. So it was here, it was 100, then 100, and you gave a loan, a withdrawal of 10. So this will be minus 10, and then but you borrow 10, end of the day is still the 100. So I said increase, so it's wrong. Here. This is yes, this is wrong. Number 3, we have unexpected withdrawal, same thing, but we address it from a fire sale. So actually this, you can look at this, you can say, okay, this is the situation, and we have liabilities, and the liabilities is dropped. For example, if this was 100, dropped by 10, and then the asset to get this, the asset, here the securities maybe or also dropped because they need to pay for those guys. I sold some assets. So this will be maybe 100 minus 10, 90, and then this is the 100 minus what I sold, 90. So the assets could be dropped to 90 and 90, and while it was 100. Okay, so number 3 is actually wrong. And loan commitments, and I put it from cash holding, not change. No, actually it will be a drop, decrease in the size. Loan commitment, I bought it from cash holdings. Is it not change? So you have an asset. Yeah, the asset is the loan commitment increases, the cash will decreases with the same amount. So if it is 100, there will be a drop in the cash in 10 and increase by the loans of 10 still the same. So the question is no change. And therefore, the statement like increase, decrease, increase, decrease is not right. Only two of them, right? So the statement, so the table, the information in the table, and this one is false. Is not all correct. Only two of them is correct. This is a little bit challenging question. Now, CryptoBank is a recent established bank in Hong Kong. In view of the recent demonstration, there has been higher demand deposits, withdrawal causing a little pressure on liquidity. Fine. So we have this, the liability is dropping. Okay. In view of the potential liquidity risk, the board has discussed the issue and has some concern about the ongoing shrinking size of the bank and is potentially and this potential represents a potential liquidity risk. If the same random withdrawal behavior is expected to continue for the next year, which means the withdrawal, what will be the impact of the size of the bank? And I bring too many, statements. Actually, if this behavior continue from the, then we will have a drop. And when we have a drop, then in this case, the size will be decreasing. But here, the problem with statement number one is here. When we say will stay the same, it will not stay the same. Since they will sell, if they say this, if the withdrawal will continue and you will sell assets, the size will drop. So this statement number one is not right. Will continue to be the same, and number two is not going to continue to be the same anyways, assuming that they give more loans financed by purchased liquidity. I understand that you have a liability now going down, and so the size will drop. But in the same time, I am also giving loans, and I'm giving loans from liquidity, so from purchased from liability. So actually, I'm getting here more loans and I'm getting here more liabilities, but the liabilities in general is dropping, so it will not stay the same. Number three, if the same random withdrawal behavior is expected to continue for next year, the size of the bank will increase if the bank manages to issue a 1-year certificate of deposits to pay for the unexpected. No, if we are going to finance now this liability by another liability, which is a CD, then in this case, the size will not increase. The size will stay the same. This is the problem. Size will stay the same. Number four, if the same random withdrawal behavior is expected to continue for the next year, the size of the bank will stay the same. No, it will not stay the same. If the bank manages to raise needed fund for withdrawn deposits from both interbank market and from sales. From interbank market, fine. But from sale of their cash, for example, if they are increasing sale of their cash assets, then that will decrease, even if it is 90%. This is the problem with this statement. If you take this thing out, then the statement is right. If you bring this statement to the picture, then this statement is wrong. If you bring this to the picture, then this is the problem which we have with this statement. And therefore, all of them are not right. And so we choose this one. Okay. This is at the end of the year. You were assigned by the ELCO to, in one of these big banks in Kuala Lumpur, to assess liquidity needs for the next year. Your team has collected data for the net deposit for the last 250 days, which looks 1 year, and found that the mean of this observation is, which means it's like this. Oh, excuse me. This is the mean, which means there is actually more withdrawals and standard deviation of 1. Your team found also that the bank has excellent market portfolio in the region and can easily raise needed funds to address the unexpected withdrawal, and the issue holds certificate of deposits with reasonable risk in Sydney, Kuala Lumpur, and Tokyo. Which of the following is true? Now, if we take this statement, the blue one, which I highlighted in blue, you can say it's 3% with standard deviation of either you can take 90 or 90 or 95 or 90 or 90, depends on the standard deviation. So in here, for example, I tried to confuse you. We are saying 90%, which means 3% plus 1% and minus 1%. So this is 4% become here 4%. And this is becoming 2%, which means it would be between 2 and 4. That is correct. It's not correct because I can actually impact this one. If I'm not raising anything, then if I'm not raising anything, then in this case, I can see the increase of deposits will be between 2 and 4. But we have here addressed unexpected role by whole certificate of deposits with reasonable cost in Sydney. So that actually impact. So actually it should be, there is no impact. It should be this one is not right, this one is not right, this one is not right. I don't know how much is the certificate of deposits, but it will take the withdrawal. So all of this, what happened during this 250 days will actually, this, drop of 2 and 4% will be compensated by the, issuing those certificate of deposits. And so all those statements, actually, they will not be decrease or increase in the deposits, and therefore this statement is the right one. Even this one, the bank will decrease in size. It will not decrease in size, it will stay the same. So all of those, the bank size will stay the same. This is the right statement because we have deposits. As I told you, I'm just trying to merge two problems in one concept, which means you have deposit withdrawals drop and you have deposit increase. The impact is between 2 and 4. The medium is 3%, the average. But actually, we have also a certificate of deposits coming here. in the liabilities. And that's actually impacted and it equals the amount that was withdrawn. Yeah, the question is, which of the following is not true? This should be which of the following, thank you. Is true. So the true one is E. I will amend this one. I'm sorry. Thank you for the question, for the comment. So which one is true? This is the true one. Okay. Any other questions in this stage, or can I move? Okay. Which of the following statement is true about depository institutions? This is just a theory question. This is the difference between maturity, because one of the what we call questions in the tutorial is talking about the maturity and the liquidity, and we say when there is a difference between the maturity of the assets minus maturity of liabilities, then in this case we expect the liquidity problems. And the question was there, it helps when the interest rate is increasing, then we like this because we need this because the assets minus liabilities will be positive gap if you are talking about interest rate. If you are talking about liquidity, then if the asset is higher than liabilities, which means you have always money locked up in those long-term assets, and you have a liquidity problem. Now, this question is trying to test your understanding of this issue and this issue. So if the difference between the average maturity of its asset is greater than the average maturity of its liabilities, both liquidity and interest rate risk increases. No, liquidity increases, this decreases. And actually depends on the interest rate, but the whole statement is not right. Even if you expect an interest rate to go even if you expect the interest rates to go up, there is not enough information. So the statement is not true. So the average, we understand this is right, but the interest rate risk increases only if the interest rate, if the rate is decreases. If the interest rate risk increases only if the I decreases. So the statement actually not complete and therefore not correct. If the difference between the average maturity of assets is greater than the average maturity of liabilities, both liability and interest rate risk increases. There is nothing called liability risk. There is liquidity risk. Liability risk is not here, is not an issue here. And liability risk, we don't address it by the liquidity issue. Liability risk is a different issue and it's not in context here. So this makes this statement also wrong. Number 3, if the average maturity of assets is greater than average maturity of liabilities, liquidity risk increases. Yes, we agree. And interest rate risk decreases Okay, when? If the market interest rate decreases. No, if the market increases. Because now we will have benefit from that one. So all of those actually, if you just ignore all of this and look at this statement, which is liquidity and interest rate management, liquidity risk and interest rate risk management objectives are conflicting, that is right. Because if you look at this, if you look at the gap when the interest rate is increasing, so if the interest rate is increasing, there is a risk here if the interest rate is decreasing. And there is no risk if the interest rate is increasing. And therefore, you are managing the liabilities. And usually if the interest rate is increasing, you want this to be higher and you want this to be lower. However, when you are talking about liquidity, you want the risk sensitive asset, you want actually the maturity of assets, which is the assets, you want more liabilities. Actually, you want this liability to be there so you can have more liquidity. So the maturity of assets and actually the liquidity should be, you want it to be higher than the, and you have to take care of this area, which is the liabilities. So when we talk about when we talk about liquidity, we are concerned about increasing the liability size. When we talk about assets, when the interest rate is increasing, we are concerned about the risk sensitive assets when the interest rate is increasing. End of the day, there is actually conflict to manage those two issues. This guy is talking about maturity all the time. This one talks about maturity of assets to be higher than the liabilities when the interest rate is increasing. But this one is sticking to a position which wants always maturity of the liabilities to be shorter so they can have more liability. So end of the day, as I told you, there is actually a conflict of managing those two risks. Which of the following statement is true? The stock liquidity assets held in financial institution balance sheet will depend on the financial institution willingness to trade off liquidity against return. You remember when we talked about the management of long-term assets, of liquidity. So you can have less cash or liquid assets, but then more assets. This will give you, end of the day, high return. Or you can have more liquidity which is in cash and very short securities that give you less return, and actually less long-term assets. Here, long-term assets is high. And therefore, you have liquidity risk, but you have higher return. Lower return, excuse me. Lower return. As you can see now, here is less risk, but more risk, but higher return. Here is less risk, but lower return. So actually, how to manage those ones, how much you keep in cash stock, which means the liquid assets, depends on your considerations of the risk and the return, which is, this is what we are saying. Willingness of the trade-off of liquidity against returns and on the ability to use purchase liquidity, which means I can always have less liquidity, no problem, like big banks. But then when I'm stuck and under stress of liquidity, I can go and purchase, which means I have good profile in the market, which I can buy, issue stocks, bonds, borrow from the central bank, borrow from the interbank. I always can purchase liquidity. In this case, I am safe to have less liquidity. It is safe here now to have less liquidity. It's safe here to have less liquidity and get to take this position. Less liquidity and higher assets and get higher return. If you are stressed with liquidity, you go and purchase. So, and this is what make this statement correct. The other statements are okay. Depends on the financial willingness to trade. Until here is okay, but not its ability to use purchase liquidity. This is the problem, but not. The third one, the stock liquidity assets held in the financial, still the same statement. It will depend on, however, on its ability to use purchased liquidity. Is to trade off liquidity against returns. It will depend, however, on its ability to use purchase liquidity. About this statement, the stock of liquidity assets held in financial institution balance sheet will not, this is the problem. This is the problem. The rest of the statement is okay. It's just this is a problem. Number D, let me just color it. Okay. Number D, the stock liquidity assets held in financial balance sheet will neither depend on this one, the problem. Okay, then we are done with this question. So, which makes actually statement number one is the correct one. Okay, which of the following liability produces does not have withdrawal risk? My friends, in the book, you may find something different, but actually CDs, it's CDs, this is the answer. This one can be withdrawn. In the book, say less, some of the resources, but actually CDs, especially whole CDs, you issue for 1 year. And buyers of the CD can actually trade it. And when you trade it with other investors. But cannot go back to the bank. You cannot withdraw it before 1 year. Issue for 1 year, and then you can trade it among others, between other investors, but you cannot go to the bank before 1 year. And this is actually doesn't have withdrawal risk. The right answer, it doesn't have actually an expected withdrawal risk. It have a withdrawal, you'll have to withdraw it after 1 year, but it doesn't have an expected withdrawal risk, which means it doesn't actually have, I think I should increase here unexpected. So it's the CD. It's a law. It has a law. If the bank agrees if the bank agrees to discount it, yes, you can withdraw, but you cannot force the bank. If the bank does not pay you before 1 year, it's not defaulting, and therefore there is no actually withdrawal risk. It's not like retail deposits and all these issues. Okay, this one, I think, did anybody calculate here? If I am not right, if I am correct, so you have this customer who has 500. The bank, 500, they will give you 5%. Now, we are trying to calculate the implicit interest rate risk for this customer. Implicit interest rate risk has to take into consideration the following. The fees they are charging you, and also the services they are providing to you free. So this customer has the rules of the bank. They will give you 5% interest if your balance is $500 and above. So over 500 or equal to 500, they will give you 5%. This is the bank. Now, this customer has 300 for 9 months. Because I need now to calculate the interest rate given to this customer, and then the other, free charges, free services provided, and that will be the interest, and that will be the return, the implicit and the explicit interest return for this customer. So in this one, he will get 0 because it is less than 500. So bank will grant 0 interest. Now he has also 900 and keep it for 3 months. So in this 900, so he will get 3/12, and this is 5%. And he will get here, if I am not mistaken, 240. And then these people are issuing, this customer is issuing 10 checks every, this is the services they are providing, and they're not charging the customer. So the services is actually, this is 10 checks, and for 12 months, they issue 10 checks for each month for 12 months, and this actually equals 2 cents. So this is actually anybody calculate this one? I think this is 1,225. And this one is actually 2. So actually you have 425. Now, how much is the outstanding balance? The customer is holding 300 for 9 months, plus 800, plus this is 800, I think. So 800, 3 over 12. This make it the average for 25. So you divided this is the balance. Anybody calculate with me again? I think I get here this is 10, and this is 240. I'm sorry. This make it 2.98. This is what the customer is actually costing us. Okay. Let's go to the next problem. Which of the following implicit interest of 100,000? So actually, you have 100,000. If the bank average management cost is 2,500 and the annual fees is 1,750. So actually, the bank is giving 2,500 as interest and charging you 1,750. So actually, the net is 750, and your balance is 100,000. This make it 2075 basis points. So you have to take this one from this one. Any questions? Okay. I will just continue. So it should be 292 for question 7. $298. What did you get? 292. Please try it again. 1240. Please guys calculate with us. So you have 240. I got 292. Using my numbers, right? Yeah, it's actually 2917, right? So it's to it's none of the, so it's 292. You are right. Okay, we have only now 6 minutes, I think, and I can continue with what I have. I cannot finish the recording, but I will upload for you the answers. I think this is the correct one. Question number 8. Yeah, what about question number 8? All good, okay. Okay, we here, there was a recommendation here. There was, I think, it's almost 6:30, so let me just go and increase likelihood to none of the above, it decrease the likelihood of run. This is about bank run. For question 7, why do we have to divide by 425? For question 7, we divide by 425 because because this is the amounts, right? He didn't hold that 300 for the whole year, and he didn't hold the 800 for the whole year. He just hold it for, this is for 9 months, and this is for 3 months. So if you calculate now this one, you will get the average holding is 425. Make sense, my friend? You see, okay, good. So let's go to this one. This is about bank run, none of the above, it decreases the likelihood. So this is the normally of credit insurance, deposit insurance, all of those is not right. It's only this one. Let me just go to this one. This one, we just have to take this one and decrease it. You take this one, the sources, and you decrease it from this, and you get this number. Okay, let me just, it's now 6:27. Should I just record this, the workshop, the main problem, and send it to you? Or let me just finish the, let me just finish. Okay, this is question number 12. I will upload this one anytime. Anyways, this is the I, this is the actual liquidity index, which is 1 to n, weight B over B star. And according to my calculation, it's 0.50 plus 0.50. And this one is times 185 over 200 plus 700 over 800. And this will make it 90%. And so it's none of the, I think I have only one more calculation, which is No more calculations here. This one we have, say, 100 shareholders, invested 10 for 1,000. If the assets of the mutual fund are worth 900, what is the net value of the, so the net value actually now is 900. Which is 9. So it's still none of this. The problems for liquidity is over until here. So I will upload this, and the rest of those, there is only calculations at the end in the portfolio. So hopefully I will see what I can do with it. But anyways, I will upload for you the answers and the recording until now. This is all credit risk, which we have covered very well. And this is the problems of the liquidities, which we already finished. Okay, guys, I will let you go now. And thank you very much.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you very much. Good luck.